Hi, good afternoon, everybody, and welcome to our first quarter market outlook. I'm Erich Patten, Cutler's Chief Investment Officer, and I'm joined today by Stanley Barnes, who's a chartered financial analyst and associate wealth advisor here at Cutler. And thank you, Stanley, for sharing your expertise with us this afternoon. As a panelist, I have a live update of the participants. It's great to see so many existing clients, but also new names joining us for this webinar. If you're new to Cutler, welcome. Especially want to welcome the Patton and Dave's clients who might be joining us for the first time today. This is a quarterly webinar. We do this every 3 months. And what we do is we really talk about what happened in the previous quarter, but we also share our outlook for moving forward and some ideas that we have around positioning portfolios, how you might want your asset allocation to look as you move throughout the year. So let's jump right into it, Stanley. First, we always start with our disclosures. What I think is most important, Stanley and I are going to be sharing some very specific ideas and some very specific commentary. But if you want to know how that might impact your portfolio or your situation, please talk to your financial advisor before taking any action, because something we might have a lot of conviction about might be a small piece of your portfolio or your total picture. So let's communicate with each other, talk with your financial advisor, and share really your reaction and your thoughts as to what we're saying today. But here we are. Here's today's agenda. We're going to start with our market review and outlook. We've titled that "The Bull Keeps Running," and really 2024 started out a lot like 2023 with a little bit of differences that Stanley's going to jump into shortly. And then the second section is interest rates recalibrate, and that really is current market dynamics, really talking about April, looking forward to the rest of the year. So a little bit after the first quarter, but things have changed quite a bit, and it's worth talking about where we think things are headed. And then finally, can the economy keep this up? We've had a run of great economic news. The market has reacted to that. Inflation has reacted to that. Interest rates, they're all related. We're going to talk about the economy, what's happening, and really where we think things are headed. But Stanley, really for those who might not make it to the very end, this is probably only about a 30-minute webinar, but why don't you provide an executive summary for everybody? Let them know what we're going to be talking about.
Yes, so the first item to note is that stocks were up pretty much across the board in the first quarter, and it was really a continuation of 2023's trend. Large cap growth stocks and US stocks really led the charge. Again, very strong returns across the board in that area. But for stocks overall, even internationally, fixed income was not quite as strong. One item to note is that April has somewhat reversed. Obviously, inflation data came in, it was somewhat high, closer to 4%, really above the Federal Reserve's 2% expected rate and target rate. But what we really saw was bonds have sold off and stocks have sold off so far in the second quarter to start. And then the next item is geopolitically, quite a few items going on. Obviously, the Russia-Ukraine conflict continues to happen. That has affected oil prices. Ukraine has actually been hitting Russian oil facilities, which has really hurt the price of oil. And then there is a war going on between Israel and Hamas in the Middle East that has also had an effect on oil prices. And that could potentially grow and become bigger, and hopefully not, but we shall see. And then the last item to note is that the U.S. economy has really continued to do well. Consumer spending has been very strong across the board, and U.S. incomes for laborers across the board have really gone up quite substantially, and the U.S. economy continues to grow, especially relative to the rest of the world.
Yeah, Stanley, we mentioned 2022 really continued into 2023 really continued into 2024. Let's talk a little bit about that and really what's the same and what has been different thus far this year.
Yeah, so the number one item is, again, we have the Magnificent Seven right here, the largest companies in the S&P 500, all well-known names. This is the returns from 2023, all up significantly more than the S&P 500 overall, and really led the charge. That has generally been a continued trend. NVIDIA has, again, been the number one performing company in the S&P 500, and large cap growth really has done quite well. You'll see right here, NVIDIA up so far 82% year to date. I guess number two in the S&P 500. Meta Platforms, also known as Facebook, doing very well. Yes, Apple and Tesla have been negative, but overall, the other 5 companies have been very positive and again, really led the S&P 500 higher.
Yeah, it seems every few years Wall Street coins a new term. Last year we learned the Magnificent Seven, which is really just a continuation of FANGs, which were Facebook, Apple, Amazon, Netflix, and Google. Back before a couple of those changed their names to new company names. But based on this chart, we may be getting a new name rather soon. Tesla has been a pretty significant underperformer this year. I believe after today, it's down about 40% year to date. So it's really given back some of last year's phenomenal returns. But what has that meant for the breadth of the market? Stanley can walk us through this next chart, which is really comparing this S&P equal weighted return versus the S&P. What does that mean, Stanley? What's the difference between those indexes?
So the S&P 500 is a market cap weighted index, meaning the larger companies such as Apple, Amazon, they'll have a much bigger impact on the performance of the index than the smaller companies. What the equal weight index does is it takes every single company and weights them equally. And what this shows is the relative returns of the equal weight versus the market cap weighted index. And what you'll see is if you look at June 30th, 2023, since then, really the S&P 500 as a whole has heavily outperformed the equal weighted index. And again, that goes back to the mega cap, large cap growth companies really outperforming. If you look at the 1-year figures down below, only 11% of S&P 500 constituents outperformed the index as a whole, versus over the last month, it's been 48%, over the last 2 months, 28%, in 3 months, 40%. So we really are starting to see more broad market positive returns overall. But again, it is still led by and large by those generally larger companies.
Yeah, and that's not overly surprising with Microsoft and Apple being over 7% and really seeing the performance from those very specific artificial intelligence or technology types of stocks. It's not surprising to see that outperformance, but really that breadth is healthy for the market. We like to see participation from other asset classes and other sectors. This chart, we show it every quarter on this webinar, and this is our quilt chart, and it extends beyond just the S&P 500. So the S&P is really the most widely followed index, but it's represented by the black square here on this chart. And you can see in the first quarter, it was up about 10.5%. Large cap growth, namely the Magnificent Seven stocks, was up about 11%, but value stocks were up 9%. They've really narrowed that performance gap, and we've really started to see much broader participation, which Cutler views as a good thing for the health of the overall market. But as we march down this list of asset classes, bonds have lagged, and we'll talk about bonds quite a bit later in the presentation as well. But one asset class I really want to point out are small cap stocks. Small cap stocks in a bull market traditionally have done very well. They're a higher volatile asset class, meaning you expect higher risk, but also higher returns. You can see here in an up market, they only return 2.5%. Well, what's going on with the small cap stock space? It's really been all about interest rates. On this chart, we show the percent of unprofitable companies in each of these various asset classes. So small cap stocks are small companies, and you move up the spectrum to mid cap, to large cap. It makes sense that large cap are more profitable because that's how you become a big company, right? You make money and the market rewards you for making money and you become a large cap company. So this is not unusual, but this is the dynamics that small caps are looking at. The small cap index, as interest rates came down in the fourth quarter, was up about 16%. That was largely on that expectation of lower rates heading into 2024. But we've given back some of those gains, and actually small caps have turned negative thus far this year as the interest rate dynamic has changed. Stanley, on the bottom of this page, what does the interest rate coverage ratio show us?
So the interest rate coverage ratio shows us the earnings before interest and tax divided by the interest expense on debt. And what it basically is are companies able to cover their debt burdens and service their interest coverage? And what we're looking at here is in gray, you'll see the large cap companies. They back in 2022, they had a 10 times ratio where for every dollar they had to pay in interest, they had $10 in earnings before interest and tax. They were significantly better financed than the small cap companies. Now the small caps, they were about 2.5 to 3 times their interest coverage ratio. And what we've seen is with interest rates now moving forward, they're quite a bit higher. Those coverage ratios have gone down a little bit. Yes, profits are up, but because of higher interest rates, the interest expense is up significantly more. And that impacts smaller companies a lot more than larger companies, which tend to have lower ratios. And then on top of that, larger companies tend to have far further dated out maturities for their debt. They're locking in rates for 15, 20 years. Smaller companies tend to be in a much shorter time frame. So we're looking at 2, 3, 4 years. And the risk there is if they're rolling over their debt into higher interest rate loans, that can really affect their financial performance.
Yeah, and this is not surprising. The market's very smart, and the market knows this dynamic. And small cap valuations reflect this expectation of interest rates, and they adjust very quickly. This chart shows large cap valuations. So again, back to the S&P 500, and what you can see is that valuations here are very high. The S&P on a forward basis is trading currently at 21 times earnings. That's a peak, not quite at the tech bubble of 25 times earnings, but matches the 2022 number of 21.4 times earnings. What does that mean? It doesn't mean that stocks have to sell off. And down the hall, Brooke Anderson, who's our chief operating officer and an advisor here at Cutler, loves to say, in the short term, valuations are a horrible market timing mechanism. Stocks can stay at 21 times earnings. And in fact, if you look at this next chart, what has happened in years where stocks started as well as they did in 2024? Stocks returned over 10% in the first 60 trading days. And in all of the time periods where this has been the case, they only returned negative once. That was 1930, the Great Depression. In 1987, with the Black Monday crash in October, stocks were negative from the second, I guess, time period, the day 61 to the end of the year. But by and large, stocks have had a positive return after positive returns. So just because stocks have gone up doesn't mean you should sell your portfolio and go to cash.
One other item to note here, Eric, is people might expect volatility from the election, and yes, there could be some. But what we see here is, there was an election year in 1936, 2012, 1976 as well. And in all of those years, stocks started up and they ended up even more, generally speaking. And so we would still expect generally positive returns, even with the election and everything going on.
Yeah, that's a good point, Stanley. And for those of you that tune in regularly to this webinar, we plan to touch on election year and those impacts on your investments in our next quarterly webinar. So look ahead to that early this summer. We did mention that valuations are not a great short-term market timing tool, but long-term valuations do matter. And so at 21 times, really what that means to us as investors is that the upside for stocks is not what they once would be, right? If stocks were trading at 15 or 16 times, we would anticipate greater long-term returns from the stock market. Stanley, what does this chart show us? And is there an opportunity for investors to take advantage of some of these market dynamics?
So this is one of my favorite slides in this presentation. What I really like looking at is the S&P 500, i.e., large cap U.S. stock market versus non-U.S. stocks. And this shows the S&P 500 versus the non-U.S. global stock market. And what we see is over the 20-year average, the S&P 500 trades at about 15.6 times earnings, and the non-U.S. equity market trades at about 13. So the U.S. gets a little bit of a premium due to geopolitical stability, strong economy, a couple other reasons. Currently, the S&P 500 is at 21 times earnings, somewhat higher than the 20-year average. The non-U.S. equity market is at 13.7 times earnings, so really about in line with where it has historically traded. Now, what we do see is the divergence is between the valuation of the U.S. stock market and non-U.S. equities is really at or near an all-time high. Right now, there's a 35% discount for non-U.S. stocks relative to U.S. stocks, and normally that's in about the 15-ish% range. So there may very well be a very good opportunity here to get into non-U.S. stocks. Part of the reason that U.S. stocks trade so highly relative to non-U.S. is a strong U.S. dollar, obviously geopolitical conflicts. But when you're looking at price to earnings ratios per dollar invested, you can really get a lot more profit in non-U.S. stocks relative to U.S. stocks right now.
Yeah, Stanley, and one other comment, just looking back to the U.S. market, not all U.S. stocks trade expensively. There are definitely portions of the U.S. market that that are at a discount or have not necessarily traded at elevated levels in this market. So there's opportunities around the globe. This is just one example of something we might look at where it really jumps out as a divergence in traditional valuations.
One other item to note there is the S&P 500 is the largest, roughly 80% of the US stock market. That trades at about 21 times earnings. If you look at the mid and small cap stocks, they're actually trading at lower price to earnings ratios right now, more similar in line to their non-US companies.
Yeah, so one last kind of inside baseball chart on the stock market. I think this is a great indicator just to watch. This is the University of Michigan Consumer or Investor Sentiment Survey. And what they do is they just ask the general public, do you expect your stock portfolio to be up in the next 12 months or down in the next 12 months? And really, it can be a contrarian indicator, right? If you look at these big dips of negativity, 2008, 2022, both of those represented phenomenal buying opportunities. So there is a contrarian indicator in this statistic, but once again, it's not something that we would suggest means stocks do have to sell off, but it is something to be aware of, that when your neighbor is very happy about where the stock market is headed, that's an opportunity to perhaps look for some value, look for some opportunities out there that might be a little bit different than what everybody else is looking for. All right, so let's talk about interest rates, and we call this section interest rates recalibrate. We mean recalibrate because there's a lot of words on this page, but if you look at the bottom headline, futures markets expect 6 rate cuts in 2024 versus 4 earlier. That headline was from December. As we headed into 2024, the market had an expectation of a lot of rate cuts. Stanley, what has happened since then?
Inflation data has come in somewhat higher than expected. As you'll see right here, it peaked at about 9% in July of 2022. It came down to about 3% in May, June of last year. And since then, it's really stayed roughly flat in the 3 to 4% range. And inflation really has kind of lingered around. As I mentioned earlier, the Federal Reserve targets 2% long-term inflation, and that's the reason they raise interest rates. And really, we haven't seen inflation fall for the last, roughly year, 9 months to a year. And that is something that is concerning to the Federal Reserve, and one of the reasons they have kept interest rates higher and they haven't reduced them as quickly as people originally expected.
Yeah, some of you might notice I just skipped over a slide. I'll go back to that. This is a slide from last quarter called What If Inflation is Stickier Than Forecast? That was one of our risks heading into 2024. What I think has been really exceeding expectations has been the stock market's resilience despite this stubborn inflation. Now, we talked about the consumer price index here. That is not the only inflation index. The Fed actually prefers the PCE, the Personal Consumption Index, and those numbers will be released at the end of April. If that number comes in softer than expected, we could see a little bit of unwinding of this new trend. So that's something for investors to be aware of. We've seen a lot of whipsawing of interest rate expectations. In fact, this chart shows what happened just last week when CPI for March came in hotter than expected. And in one day, the June rate cut expectations dropped from 56% down to 14.5%. A huge shift in rate cut probabilities. We started the year at 100%. So the market can get things wrong. Nothing should ever be 100% in finance. So the market was forecasting 100% probability of a rate cut. Now the total rate cut probabilities are right around 16%. What has that done to bond prices, though? We've highlighted two regimes in bond prices just over the last 6 months. The fourth quarter, where we saw the best 2-month rally in bonds since 1982, and then the first quarter, and really extending into April, a reversal of that trend. So we saw rates go, or the 10-year Treasury go from about 5% really down to 4% in a matter of months. Today, the 10-year Treasury has given back much of that gain. and that's whipsawed bond market returns. Our position is this gives investors an opportunity to step back into perhaps some duration. Duration means the length of your time of your bond investments. So if you were short term, maybe move to medium term. If you're in cash, perhaps look into bonds. For example, money market investors are getting over 5%, 5.25%. The 2-year treasury today is now yielding about 5%. So you can lock in that 5% rate by moving out of cash into a 2-year treasury. Investors that are short-term bonds might be able to do something similar. We think there's a nice window right now for investors to be looking at putting that cash to work. Now, if you're a long-term investor, Cutler continues to advocate stocks in an asset allocation portfolio. But for those that might have cash sitting on the sidelines or lower risk investments that are in bonds, this is some action you might be able to take. As we move through April, we're really working through that inflationary trend. And Stanley, why has inflation been so sticky? Talk us through this next slide and explain what's going on with the underlying inflation dynamics.
So on the left side, we have the CPI change for different select categories year over year. You'll see motor vehicle maintenance and repair, number 1. And then what I really want to hone in on are numbers 3 and 4, owner's equivalent rent and rent of primary residence. Those were up 5.9% and 5.7% respectively year over year. If you go to the chart on the right, you'll see that shelter is close to 1/3 of the CPI. That means that 1/3 of that is coming from those 5.9% and 5.7% figures. Overall, the biggest contributor to the inflation rate right now has been housing and shelter. And those are generally speaking lagging indicators. But as many people have noticed, people are always complaining about the rent going up. That has been an issue, but those are by far the biggest contributors right now to CPI, but they are back.
Yeah, rent is, again, getting back to the PCE index, rent is a less influential component of the PCE. So keep an eye on that April 26th release date. That could be the next kind of market moving inflation data as we move ahead. What about oil prices? Oil is up about 20% or so this year. Stanley, what should we expect for oil prices moving ahead?
So oil has been up quite significantly this year, mainly because of what's happening in the Middle East as well as in Russia and Ukraine. Going forward, though, there are not large expectations of higher oil prices. There's a $79 per barrel price expected in 6 months, 81 in a year. And then if you go out 5 years, $90, that's a little bit higher than long-term inflation, but it's not massively higher. I would say it's really, really in line with what we expect long-term for inflation. And I would not say it's a big risk. Now, that being said, the bars show that there's quite a high standard deviation, and they could jump a lot. They could also go down depending on what happens internationally with oil production, et cetera.
Yeah, oil is a global supply and a global demand market. It's not localized. And as we move into talking about the economy, the U.S. economy really has been the global leader. And so growth here does not necessarily translate to global oil prices moving up. In fact, let's look at the current GDP forecast. This is a great chart, I think, that shows what's happening in the U.S. versus the rest of the world. The changes in this line, it's kind of jagged. Those changes are economist changes in forecasts. So every time an economist raises or lowers their expectation of first quarter GDP, you see an adjustment in this line. And you can see the Eurozone and the U.S. have been going in opposite directions. The Eurozone really is barely growing, while the U.S. expectation for the first quarter from economists is currently sitting at 2.2. Now, the Atlanta Fed releases a real-time GDP forecast, and currently that real-time GDP forecast for the first quarter is 2.9%. In the fourth quarter, it was 3.4%. Both of those numbers greatly exceeding expectations, really at the high end of the blue chip consensus, or even higher than the high end of the blue chip consensus, which means, in short, the economy's doing great. And the question is, why? What's pushing the economy forward? What's creating this growth? Stanley, this next chart really will give us an idea of why we're growing and where the growth is coming from.
So on the left side, you'll see the long-term trend growth rate for the U.S. economy is about 2% per year. Obviously there's pluses and minuses, and over the long term, we have reached that target, but it really has accelerated over the last year. On the right side, looking at the components of GDP, individual consumer spending, that's the private sector, private individual spending, has really been the big driver and is the biggest piece of the economy by far. And what we've seen over the last few years is incomes, both in real terms and nominal terms, have gone up substantially. That's really across the board. Even on the lower income levels, those have gone up quite a bit. We've actually seen the largest gains for those lowest incomes. And so that really has been the biggest driver of economic growth by far. The US consumer is in a very strong position to keep on spending, especially on non-discretionary items, or sorry, discretionary items. And we really should, over the long term and medium term, see higher spending there.
Yeah, and just to emphasize the importance of the U.S. consumer and consumption on our GDP growth, a big question that clients have, they ask about government spending and fiscal deficits, and that has been a big story over the last couple of years, especially. This chart shows the fiscal policy impact to real GDP growth. And you can see in 2020, after the pandemic and the stimulus that happened, fiscal policy played an outsized role in GDP growth, but that's really waned over the last couple of years. And today, it's not really contributing to that GDP growth that we're seeing. It's really all about consumption, all about the consumer and where that and what people are spending. In March, retail sales were released, and this is a breakdown of where people are spending, increases in spending. This is really hot off the presses. This data was released within the last week, and expectations were for a 0.4% increase. We got a 0.7% increase, and the market reacted favorably to that. But you can see people are still spending. The biggest increase here is called non-store. That's online. So people's Amazon accounts are still going strong. And the question is, can that continue? Can people still continue to spend at that pace? Let's discuss that for the next couple of slides, Stanley.
Yeah, so right here we have a couple of different items. The item on the left is the consumer balance sheet, and that shows total assets and then total liabilities. Now, net, the U.S. has total assets of 176 trillion, total liabilities of 20.5 trillion. So we have about $155 trillion of net assets. Again, U.S. consumer is in a very strong position. The largest item in the liabilities is mortgages, 66% of that figure. A lot of those are locked into lower interest rate mortgages, which people are likely to pay down slower now that interest rates are higher and they're locked in maybe at a 2.5%, 3.5% mortgage. And then if we go up to the top right, the household debt to service ratio, the debt payments as a percentage of total household income have really gone down quite a bit since their highs during the financial crisis. We're at about 10% right now, down about 3.5% from then. Yes, they did go down during COVID when there was stays on a lot of mortgage payments, student loans, things like that. But they've come back to being about in line where they've been over the last decade. So the U.S. consumer is really in a strong position. Now, one of the main reasons here is, yes, maybe they're paying more in interest, but again, incomes have gone up substantially, and that has allowed consumers to keep their debt payments where they were previously. The other item to note, though, and one thing that could be a little cause for concern, is if you look at the bottom right, that flows into early delinquencies. Auto loans and credit card loans have gone up, again, not at their all-time highs, which happened during the financial crisis, but they have gone up quite a bit, and that is something to be watched and is potentially a cause for concern. Not quite yet, but it is something to be looked at. The one item,
Stanley, if there's a canary in the coal mine in this presentation, it is credit card delinquencies, and seeing how rapidly those have increased is concerning. It's something to keep an eye on. Part of the explanation for that is we're currently at the highest all-time rate for credit card interest. So 21.3% is what you pay on your unpaid credit card balances. And if there's any financial advice we want to give you today, if you're carrying a balance on your credit card, pay it off, because that is the highest that we've ever seen in terms of credit card interest rates. So let's not end on that bad news. We're going to give you the silver lining here on what with credit card interest rates increasing, what might benefit the consumer? And really the story or the answer to that is wages. I want to talk about this chart right here. Wage growth on average has been about 3.9%. The most recent data in February was about 4.5%. We've been well above that historical trend for quite some time. And what that does is it gives consumers confidence to keep spending. Even with those high credit card interest rates, if your wages are growing and you think you'll have more money in the future to spend, you'll go out and spend it. And this has been a great story for the U.S. economy. It's really been a driver for GDP growth. As long as unemployment stays low, and you can see on this chart, it also shows unemployment, the 50-year average at 6.2, today right around 4%, just under 4%. As long as that unemployment rate stays low, that puts a floor under wages. It keeps America, puts more money in Americans' pockets that they can then go out and spend on non-store spending, as we saw a few slides ago. And that's been a great trend. As long as this chart stays intact, the economy is in great shape. But we wanted to end with something beyond just the investment portion of your account. We showed this chart last quarter as well. We've been talking about portfolio management and your investments. If you have questions beyond that, really from a financial planning or holistic financial position, please reach out to your financial advisor. We can answer these questions or find resources that can. If you want to talk about anything, please let us know. So Stanley and I really appreciate you taking the time today to walk through Cutler's market outlook. And we'll do it again in 3 months. But if you have any questions before then, we're always available to sit down, talk to you about how this might impact your portfolio and really walk through the ins and outs of what we talked about today. So thank you so much for spending your afternoon with us, and we wish you all a great day.